Okay, so in this lesson, what we're going to be talking about is everything that you need to know about contraction boxes when it comes to ATS software. What we're going to cover is how are they formed. We're going to talk about what do they represent, and also why are they important for understanding markets. So with that being said, let's get right into the lesson. So the first thing we're going to talk about is how are boxes formed. So the ATS algorithm, it constantly looks for price contractions or tightening. Basically, the definition of a contraction phase in the market, tightening of price. Our algorithm is constantly scanning the chart for that to trigger, and when it does, it will form a box. The boxes will usually appear when the market's making simultaneous lower highs and higher lows. Now, there's more that goes into it than just that, but as a general rule of thumb, when price is tightening up, you're going to expect to see a box pretty soon. Boxes appear on the close of a confirming candle, meaning they're in the algorithm. This is one of those things that does wait till the close of the candle to complete the sequence. So that's a box you'll notice will only appear at the exact time you're getting a new candle. The reason that we had to do it this way, because we could make the boxes appear sooner, but that would also cause them to disappear if it didn't confirm, which would cause it to repaint. So to avoid any kind of repainting, we did have to go off a close of a candle on this specific function. And like I said, I think that speaks for itself. We don't want to have anything that repaints. We want it to be what it was. So when you do your back testing, you can see an accurate representation of what happened. Now, when it does close on that current candle, the formula can be met, and the box can already be broken out on that same confirming candle. So if you ever do get a box that appears but price has already left the box, that is because of that single anomaly. And again, that is because we don't want to have anything repaint. So that will happen. It's very rare, but it can happen. It's just the way things are. So what do boxes represent? Boxes are the starting point for the next significant market move. Phase 1 of 3 in the 3 market phases, the contraction phase. The box represents the starting point of that. What they are technically, they're a defined zone where the market maker can do two-way business with buyers and sellers, meaning there's buying and selling demand in these boxes. The market maker can easily match up those trades, and the market maker can collect lower risk spread commissions in this area. So when it comes to that source of a market maker's income, their main source, which is the spread commissions, this is a very low risk area for them to collect those commissions back and forth until the market breaks. So the market maker can use this time, the time that we're in that box, to assess current overall supply and demand and plan their risk control strategy. So when we exit that box, the market maker can use that phase 2, the expansion phase, to adjust their risk in their overall book of business in preparation for the next market move to higher or lower prices. Now, I want to make a point right now. When I talk about them planning their risk control strategy, this could mean that when we go into that expansion phase, depending on what the market maker's needs are and how they need to adjust their portfolio, that can be the cause of the market whipping back down or back and forth across the box, or immediately going into phase 3, which is the trend phase. This is defined by what the market maker needs to do based on what happened in that box, where the box was formed, and under the circumstances that the box was formed. So why are boxes important? They help you define expectation of upcoming market behavior, which this can serve as an advanced volatility signal. This is really important. Let's look at an example right now. So when you see the contraction box, you see that form on your screen when the software triggers that box, what is coming next? You know that the expansion, the immediate coming out of the box and leading into the trend, you know that those two phases are next. And sometimes the expansion, remember the definition of expansion is simply leaving the box. Depending on the market maker's needs, it can go directly into the trend phase, but more times than not, you're going to get more expansion activity where it plays around with that average price line. But point is, when you get that box, you know that expansion and trend is coming next. So when it comes down to timing volatility, if you look at this trade, if you're looking for tradable markets on a daily basis, it would be better to find a market that is freshly expanded out of a box on the daily chart and start trading that more aggressively rather than a chart that has already ran in a trending direction for, say, a week or 2 weeks. So when it comes down to finding markets that are going to have volatility, which we need as traders, finding something that's in a box, that tells you that this market is about to move and money is going to be able to be made in that market easier than a market that's going to be slowing down and going into a box. You don't want to be there late. I just want to jump in on a chart real quick and show you a quick example of what I'm talking about. The timing of volatility, we're looking at a daily chart of gold right here. And you can see we had these expansions come out of the box, and right there, that would be a volatility signal, simply leaving the box, and you get a new white line, which is the expansion line, and then we get movement away from those levels. There's one, here's another one, and then eventually we do get into these tighter periods, and when you see that that's happening, then you back off of that overall market. But as a rule of thumb, that is a volatility signal. Leaving the box means that volatility is coming into the market on that time frame. And on a daily chart, if you're trading on a daily basis, trying to make money in and out of sessions, New York, London session, you would want to know when this is happening. And that's also what we have ATS Assistant for, to tell you that's a simple volatility signal, the box expansion signal, meaning that it's time to get ready to start trading this market away from average price or seeing how it behaves. Again, volatility signal right here, volatility signal right here, volatility signal here, here, here. Big, big, big moves, especially if you got a market that has as much interest in it as gold does right at this particular point. Obviously, it can slow down, but markets like Bitcoin, markets that have a lot of interest in them, a lot of people coming into those markets, these volatility signals can be extremely powerful. Okay, so the next reason boxes are important are because they provide you with the market maker's starting accumulation point for their book of business. So let's take a look at another example here. So again, we see we have a box here. We had an expansion upward, came through, fell through the average price of that contraction period, came back up, held below, and then continued on down. This is a balance point of the market maker's book of business, and these levels provide us with the point of control for the different market maker significant levels where they're going to manage their book of business. So again, this is very important information for us to use in our overall analysis when we're looking at the ATS chart map. Boxes are the basic building blocks of all market framework that dictates future price movement. Boxes, because they're that point of control, because they're the balance point of the market maker's book of business, and the market makers ultimately control the floodgates of liquidity with how they manage that book of business, these sensitive levels create that consistent market framework for our analysis and for us to form our understanding of where price is headed in the future. Okay, so I hope that clarifies your understanding of boxes, the basics of how they're formed, what they mean. Obviously, you should know that they're very important for understanding markets. The next thing we're going to talk about is expansion lines. So let's go to the next lesson. I'm going to teach you everything you need to know about expansion lines.